Priscila Barrera with the Investing News Network, and here with me today is Ryan Cochrane, Research Manager, Lead, ZInc and Precious Metals of CRU Group. Ryan, thank you so much for joining us today.
Happy to be here.
All right, so we're at day 2 of PDAC. How are you finding the conference this year? Do you see a lot of investors' interest in base metals?
I think it's certainly similar to what we saw last year. I think there's been a general uptick in the sentiment in the industry. So there's certainly an interest in zinc. That's been one that a lot of people have been watching over a few years.
All right. So yesterday you gave a presentation about the zinc outlook for this year. Let's talk first about the supply side of things. What are some of the factors that investors should watch out for this year that could impact the market?
Well, I think it's clear there's a lot of new mines coming on. There's idle capacity coming on. So if you look at things like Gamsberg, Dugald River, Olympias, the new Century tailings, this is a pretty big one, which has surprised a lot of market participants so far. And then there's the idle capacity coming back. So there's Lady Loretta from Mount Isa. The Neostar assets are coming back. And there's certainly some expansions happening as well. So there's a lot of supply coming. I think the interesting thing is the timing of it, where that comes forward. And it's our view that sort of comes forward second half of the year. So as an investor watching for the market, I think it's important to see if companies are hitting guidance, we think there's a lot of concentrate coming forward, zinc coming forward.
All right, and what about Glencore? Is that happening this year as well? Are they going to come, their production, is it going to come back online this year, or is that yet to come?
Yes, so part of that is coming, and that Lady Loretta is the high-grade deposit at Mount Isa, which will be restarted. And there's two. There's McArthur River. We think McArthur River grades will be rising as well. And so net for net, we see probably 75 to 100,000 tons of incremental growth coming from Glencore.
All right, and
or hitting the market entirely, not necessarily Glencore, but that'll be the net effect on the market.
All right, that's good. And last year there was a lot of talk about stockpiles declining, going down. Is that going to continue this year? And why is it important for investors to actually be watching out for those stockpile levels?
Well, I think last year we saw reported and exchange stocks really fall to very low levels, and we certainly expect that to continue this year. I guess the key question in the zinc market is how much unreported material there is and spread across the world. So we think we're certainly going to see tightness in the refined market, and we think the first half of the year we'll see big deficits again, and that'll imply a further drawdown in metal stockpiles for sure.
All right, and what's happening with smelters, their treatment charges? What are you expecting this year? Are they going to go up? Are they going to go down?
The market for concentrates undoubtedly tight. I mean, we saw middle of last year smelter outages, and this was really driven by lack of feed. And we think excess inventories of concentrate were depleted at some point in the middle of last year. Now, I think what's really interesting for this year is you've got Chinese winter, and China produces a large amount of the zinc in concentrate, and we always see a weak Q1. So if you compound that with a lack of new supply, at least in the short term, the sets are seen for more smelter outages going forward. So we think the market's tight. We think it should move a little bit further in favor of the miners this year. But certainly once that concentrate starts to come forward in the second half of this year, we think you probably start to see it through spot TCs rising, and certainly longer term we expect a big pickup in treatment charges. So that should swing the revenue share back towards smelters over the next few years.
All right, and let's jump to the demand side of things. What are your expectations about demand from China and outside of China?
So, I mean, China is still the demand engine. So if you look over a 5-year basis, we think about 800,000 tons of incremental growth will still come out of China. But in terms of our growth rates, we certainly have China slowing, and that's really as zinc-intensive construction sectors are slowing. There's a reining in of credit growth. And that we're certain that will constrain zinc consumption overall. There are a few bright spots. So on the automotive side, there's very limited 35 to 40% penetration of Gulf sheet in automotive. So we think there's some potential growth there. Outside of China, we think other Asia, so that and predominantly India, which will be a large portion of demand growth. There's a positive construction and automotive story there as well. Very low penetration of Gulf sheet into automotives there. And then really the rest of the world is quite small. So if we're looking at total demand over the next 5 years, we have about 1.3 million tons of incremental growth, of which China and other Asia is making up more than 1 million tons of that. So it's really coming from the east.
All right. And what about prices? Prices are at high levels.
Yes.
What do you expect? I heard you say something yesterday, so can you share it with our investors here?
I think it's a really interesting one. I think if you look at the zinc market from 1970, it's been characterized by a number of short spikes. So if you look at the typical length of those spikes, it's often been 2.5 years around about on average, and we're close to there now. So from end 2015 through to where we are now, you're getting close to that normal level of before we have a response. I think what surprised a lot of the market is you haven't seen the Chinese mine supply coming forward fast. Certainly last year it was underwhelming. We had it only up 1%. But what's clear is that now in 2018 you've got a balance where the world outside of China is expected to supply a lot more of that zinc in concentrate. So we think the turning point is going to be somewhere around the middle of this year. If producers don't hit guidance like they may, it could be pushed out slightly further. But in terms of pricing, we think peak prices will probably be middle of this year, and we think Q2 might average. I wouldn't be surprised to see 4,000 on a daily basis, but on a quarterly average, we're looking at about 3,750. Annual average for this year, 3,340 or so, and then starting to come off from 2019 onwards.
All right. And again, we have some new investors watching us today. Can you explain a little bit of who benefits from a high price environment and how will that change forward? Is it miners? Is it smelters?
Well, currently, so if you look at the mining sector right now, zinc cash margins for miners are astronomical. They're near decade highs. So it's certainly been a fabulous couple of months, I'd say, at least 6 to 12 months for the zinc mining sector. So they've certainly benefited from these high prices. Now going forward, we do expect that tilt to shift a little bit more to the downstream side, more to the smelters. But saying that, not hugely. So if you look at average revenue share of the zinc price from 1970 to 2017, smelters received about 43% of that, with miners receiving the balance. This year we expect miners will receive nearly 77% of that revenue, smelters about 23%. And over the forecast, we think that'll start to shift. So as rising TCs move up, that'll be an incremental cost to the miners. So paying higher treatment charges it'll be inflationary, and you'll see higher revenues for the smelters, and that should encourage more smelter investment.
All right, and my last question for you today. Lead also had a great 2017 in terms of prices. What factors are impacting that market?
I think the lead market, to a large degree, it's also been a concentrate story, and you're mining lead and zinc concurrently most of the time. It's very rare to have them mined independently. But the key difference in the lead and zinc market being the amount of secondary supply in lead. So you've got the replacement battery cycle, which is enormous. It's nearly 2/3 of the market. So what it means for lead is that you tend to have smaller degrees of imbalances. But it's certainly the story of recent has also been tightness. The idle capacity at end 2015, the closure of major mines, you tightened the lead concentrate story significantly. And you saw this as well with spot treatment charges falling in China. I think it's been a similar supply side story to zinc. Going forward, you could argue that a lot of the projects coming forward are more zinc rich and slightly lead poor. So you're not going to get that aggressive mine supply response in lead, not quite as acutely as you're going to see in zinc, which may keep the lead concentrate market tighter for longer. I think that's interesting. There's a slight little divergence there in terms of what's been developed in terms of zinc-rich deposits.
All right, thank you so much for joining us today,
My pleasure.
Once again, I'm Priscila with the Investing News Network, and here with me was Brian Cochrane of CRU Group.